The next topic is debt and interest rate, which makes a huge impact on today's economy and our lives. What are debt and interest rates? Debt and interest rates are important components of the financial landscape, influencing individual and institutional financial decisions. What is debt exactly? Debt refers to borrowed money that must be repaid over time, typically with interest. Individuals, businesses, and governments may incur debt for various purposes, such as funding education, purchasing a home, or financing operations. Common forms of debt include loans, mortgages, credit card balances, and bonds. While debt can provide necessary financial resources, it also comes with the obligation to repay the borrowed amount along with any interest accrued. The purpose of incurring debt varies, with individuals seeking personal financial flexibility, businesses financing operations or expansions, and governments funding public projects. Effective debt management involves strategic planning, responsible borrowing, and understanding repayment terms. It is crucial for individuals to make timely payments, consider consolidation options, and maintain a balance relative to their income. On a broader economic scale, the level of debt plays a role in influencing spending patterns and economic growth, prompting central banks to employ interest rate policies to manage inflation and overall debt levels. In essence, while debt serves as a valuable financial tool, careful management and an awareness of associated obligations are imperative to ensure that it remains a constructive force in financial planning rather than a burden. What are interest rates? Interest rates represent the cost of borrowing money or the return on investment for lending capital. Central banks, financial institutions, and markets determine interest rates, which can be fixed or variable. The level of interest rates influences borrowing and spending behaviors, impacting economic activity. Higher interest rates generally mean increased borrowing costs, potentially slowing down economic growth, while lower rates can stimulate borrowing and investment. Individuals encounter interest rates in various financial products, such as loans, credit cards, savings accounts, and investments. Borrowers pay interest as a fee for borrowing money, while savers and investors earn interest as a return. Central banks utilize interest rates as a tool to control inflation, manage economic growth, and stabilize financial markets. Understanding interest rates is essential for informed financial decisions, empowering individuals and businesses to navigate economic conditions and optimize their financial strategies. What is the relationship between debt and interest rates? The relationship between debt and interest rates is crucial for financial decision-making. When individuals or entities borrow money, the interest rate determines the cost of that debt. Higher interest rates lead to more expensive borrowing, increasing the overall amount repaid. Conversely, lower interest rates make borrowing more affordable. Understanding the terms of debt, including interest rates and repayment schedules, is essential for managing financial obligations effectively. High levels of debt coupled with high interest rates can lead to financial strain, making it challenging to meet repayment obligations. On the other hand, strategic management of debt, such as consolidating high-interest debt or refinancing at lower rates, can help individuals reduce overall interest costs. Central banks use interest rate policies to influence inflation, employment, and overall economic stability. Changes in interest rates can have ripple effects on consumer spending, business investments, and housing markets, impacting the overall health of an economy.